what's the difference between a fixed interest rate and an adjustable interest rate, and when is one better than the other?
Okay. And the fixed interest rate and adjustable interest rates, it just depends on the needs of the buyer in that situation. Fixed interest rates, basically, that interest rate, the principal and interest from that mortgage will not go up, it will not go down. It is as like it's mentioned as a fixed interest rate, period, point blank, between 1 to 30 years. The only thing that you would have to worry about in this situation would be the increase of the mortgage or the property taxes or your homeowner's insurance. An adjustable rate mortgage usually has a tendency to start at a lower interest rate, but the term escapes me. But it maxes out. It max out at a certain percent number. So, for example, you may start off at a 2.5% interest rate, but once the loan fully matures, you're looking at an interest rate at 6% or 5%. It just depends on what the environment and what's called for in the marketplace.
Okay, but when would one be better than another?
A circumstance that may be ideal for an adjustable mortgage rate is an individual who is not necessarily like a doctor, I would say. Still in medical school, they may be there in that home for only 3 years. Well, with that being said, you may be able to give them a loan that gives them the interest that allows them to only pay interest only on the loan. However, if you decide to say, okay, hey, I think I'm going to be here a little bit longer. I'm definitely beginning to raise a family. I wanted to take roots before that loan, that interest rate goes up on them, meaning that, it increases, but maybe by a point or two. They look to switch over or refinance into a fixed interest rate, which basically across the board, like I mentioned before, stays the same throughout the life of the loan.
Okay, so then as a general rule, is it the case that the longer a person has a loan,
mm-hmm.
more likely it is that they should use a fixed rate?
I would definitely recommend that. Fixed interest rates, you don't have any surprises by year 8, year 10. You know that it is based on, that full term for 30 years. So your monthly payment, short of your property taxes increasing or you changing out your homeowner's insurance, will stay the same.
So how much advance notice is a person given before the interest rate goes up, if you're doing a variable?
Usually they will, if you're doing a variable interest rate, usually they send out yearly updates on what the interest rate will be, or and once it gets closer to that max out rate, so to speak, they would then begin getting notifications and calls even from that said servicer or lending company to change, to possibly look in and explore doing a fixed rate mortgage.
I'm sorry, did you say that you get the notification yearly?
You would get notification. You would get notifications closer to the time frame that the interest rate will be at its full power, full strength, its peak.
So I'm saying, if if I take out a loan, or if
Hmm.
I get a loan, uh, I apply for a loan tomorrow. Uh, I decide to do, and I think I said variable. I don't know the terms. Is it the same? Is that the same? Is that an arm like rate?
Variable is adjustable, variable, same thing.
Okay, all right. So we had a little bit of a signal issue. Adjustable. So when people say an arm, are they talking about an adjustable rate mortgage?
That is correct,
All
yes.
right. Okay, so I get a variable or I get an adjustable rate mortgage, and I start paying on it. Let's say March 1st. Um, and am I going to get notification in June that beginning September 1st, the interest rate is this? Or am I getting notification in June that beginning January 1st of the following year, the interest rate is this?
Yes, and actually, as a matter of fact, they usually adjust according to the year. So
Okay.
you don't have to worry about something where you close one month as being 2% and now it's 4%, 3 or 4 months down the line. They usually have a year increment time frame where the interest rate will adjust accordingly.
So, and so then this might be a little risky. Maybe it's not for everybody, so to speak, but could some say, hey, let me see what this adjustable rate mortgage is.
Hmm.
Oh, it's 3%.
Hmm.
And uh, uh, and then I just keep paying the 3. And then when you tell me, or when someone tells me, hey, 6 months from now, we're expecting you to go up to 5, couldn't I then just start reaching out and applying for other loan products or services?
Absolutely. 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 Um, you are not locked. The only thing that we ask as lenders when you start to make that transition to going to a fixed rate mortgage is that you've at least had a bare minimum of between 12 and 18 months of on-time payments with your existing mortgage.
Okay. And then am I punished, for lack of a better way to say it, by mortgage shopping?
No.
Okay.
Well, when there's no such thing as a punishment as far as this is concerned. Um, there are inquiries that in the process of looking around for a mortgage. There are inquiries that you will have. But and I'm no credit expert by any means, let that be known. But um, history has determined that, say, for instance, you're looking at a Chase Bank, you're looking at TCU, a Freedom Mortgage, or something like that, and you're trying to find the best interest rate. What it determines is that you are shopping for a house when every time that you have a credit pool, which probably would be within the term of maybe 30 to 45 days. Um, but if you go and say, hey, I'm looking for a house, and then you run to a furniture store, say, oh, I'm looking for opening up a line of credit there, while in the process of trying to refinance a car or finance a car, then at that point in time, it's going across different lines of credit, which makes you appear desperate for credit. Just depends on the frequency of how many times you have your credit pulled,
Okay.
which as a result can have harder hits and hurt your credit score a little bit more, as in comparison to just looking in one category of lending or of financing in this case.